Rupee opened the earlier week at 74.13 and due to whooping rise in domestic equities as well as the dollar's weakness against the major currencies led to a rise in the rupee to breach the 73.80 support level, and on Thursday the rupee touched a high of 73.7350, but the moderate intervention from RBI pushed the rupee to trade lower above the 73.80 level and ended the week at 74.05. Portfolio investors have bought over 8.12 billion worth of equities and debt in November 2020 till 26/11/2020. The portfolio inflows in November were the highest SPI inflows received in a calendar month. The marginal upside revision in the MSCI index has helped more equity inflows to pour into the domestic market in the recent weeks. Unlike the Asian currencies, which have shown sharp appreciation against the dollar from the beginning of January 2020 till date, Indian rupee maintained an exception with depreciation of over 3.50% in the corresponding period. As the domestic economy recovered from the pandemic, the possibility of a swift recovery in the Indian economy can be seen from the beginning of the last quarter in the current fiscal, which could increase the dollar buying pressure from the market to ensure that the rupee's appreciation is capped at 73.50 level. On the other hand, if RBI changes its stance and goes slow in absorbing the foreign inflows as it did in late August, the rupee might swiftly gain to test the 73.00 solid resistance level before any sustained recovery can be seen. We are expecting two-way currency movements in the range between 73.30 to 75.50 in the next 3 to 4 months period from now, and hence selling of export receivables in various tranches up to 6-month maturities at the spot target level of 74.30 or better would be the best strategy to enhance the export realization. For importers who are availing financing under the supplier's credit and buyer's credit facilities, it would be a good strategy to hedge the forex liabilities simultaneous to availment of trade credit facilities to crystallize the lower cost in rupee terms. During the period from the beginning of November till date, the portfolio flows were positive at USD 8.12 billion. It should be noted that from the huge portfolio outflow of USD 18,003 million as of 27/5/2020, we have seen large portfolio inflows of USD 26,132 million in the last 6 months period from 27th May 2020 to 26th November 2020, and the net portfolio inflow stood at USD 8.12 billion as of 26/11/2020. The position of portfolio and FDI inflows pushed the rupee higher from an all-time low of 76.9050 registered on 22nd April 2020 to the current level of 73.80. After nearly 24% contraction in the first quarter of the current fiscal, a number of favorable indicators point out to gradual signs of pickup to support the overall recovery in the economy. The quarter 2 GDP stood at 7.5%. Analysts expect a significant sequential rebound in the numbers, even as they may remain in the negative. In fact, we are seeing a good pickup in indicators like vehicle sales, real estate, manufacturing PMI, and railway freight earnings, which have outstripped the September 2019 data on the above segment. Foreign investors are piling money into major Asian equity markets outside of China at the fastest pace in 7 years this quarter, as vaccine successes add to the global risk-on mood. 9 regional stocks have lured a combined amount of USD 48 billion since the beginning of October 2020, the most since the fourth quarter of 2013. Japan is leading with equity inflows of USD 24.4 billion, followed by India by USD 9.2 billion and South Korea by USD 6.4 billion. The global developments improve the appetite for riskier assets, but we believe the central bank may not allow the rupee to appreciate sharply. The central bank is putting their best efforts to slow down the rupee's appreciation in view of the big foreign inflows coming in and added to the global risk-on move. The global oil prices are sharply moving up, which would allow a gradual appreciation in the rupee exchange rate after breaching the 73.80 support level.